Chapter 2. The Education of Warren Buffett. Even a Five Sigma phenomenon with a stunningly powerful intellect must rely on the teachings of those who came before him, for not even he can skip the process of learning his trade. Warren Buffett's education is, as we shall see, a synthesis of three distinct investment philosophies from the minds of three powerful figures: Benjamin Graham, Philip Fisher, and Charlie Munger. The Graham influence on Buffett is well known. In fact, some consider it all-encompassing. This is not altogether surprising, considering the entwined histories of the two men. Buffett was first an interested reader of Graham, then a student, an employee, a collaborator, and, finally, Graham's peer. Graham molded Buffett's untrained mind. However, those who consider Buffett to be the singular product of Graham's teachings are ignoring the influence of two other towering financial thinkers, Philip Fisher and Charlie Munger. We will study both of them in this chapter. Benjamin Graham. Graham is considered the dean of financial analysis. As Adam Smith notes, before him there was no financial analysis profession, and after him they call it that. Today he is best known for two celebrated works, Security Analysis, co-authored with David Dodd and originally published in 1934, and The Intelligent Investor, originally published in 1949. Part of the enduring significance of security analysis is its timing. This seminal book appeared just a few years after the 1929 stock market crash, a world-changing event that had a major impact on the author and profoundly influenced his ideas. While other academicians sought to explain this economic phenomenon, Graham helped people regain their financial footing and proceed with a profitable course of action. Ben Graham earned a Bachelor of Science degree from Columbia University in 1914, at the age of 20. He was fluent in Greek and Latin and had a scholarly interest in mathematics and philosophy. However, despite his no business education, he began a career on Wall Street. His first job was as a messenger at the brokerage firm of Neuberger, Henderson, and Loeb, posting bond and stock prices on a blackboard for $12 a week. From messenger, he rose to writing research reports and soon was awarded a partnership in the firm. By 1919, at age 25, he was earning an annual salary of $600,000, almost $8 million in 2012 dollars. In 1926, Graham formed an investment partnership with Jerome Newman. It was this partnership that hired Buffett some 30 years later. Graham Newman survived the 1929 crash, the Great Depression, World War II, and the Korean War, before it was dissolved in 1956. Few people know that Graham was financially ruined by the 1929 crash. For the second time in his life, the first being when his father died, leaving the family financially unprotected, Graham set about to rebuild his fortune. He found inspiration at his alma mater, where he had just started teaching night courses in finance. The haven of academia allowed Graham the opportunity for reflection and reevaluation. With the counsel of David Dodd, also a professor at Columbia, Graham produced what became the classic treatise on conservative investing. Between them, Graham and Dodd had over 15 years of investment experience. It took them 4 years to complete Security Analysis. When the book first appeared, in 1934, Louis Rich wrote in the New York Times, "It is a full-bodied, mature, meticulous and wholly meritorious outgrowth of scholarly probing and practical sagacity. If this influence should ever exert itself, it will come by causing the mind of the investor to dwell upon securities rather than upon the market." In the first edition, Graham and Dodd dedicated significant attention to corporate abuses. They had plenty of material. Before the Securities Act of 1933 and the Securities Exchange Act of 1934, corporate information was totally inadequate and often misleading. Most companies refused to divulge sales information, and the valuation of assets was frequently suspect. Corporate misinformation was used to manipulate the prices of securities, both in initial public offerings and in the aftermarkets. After the Securities Acts, corporate reforms were slow but deliberate. By the time the third edition of the book appeared in 1951, references to corporate abuses were eliminated and, in their place, Graham and Dodd addressed the problems of stockholder-management relations, principally management's competence and the policy of dividends. The essence of security analysis is that a well-chosen diversified portfolio of common stocks, based on reasonable prices, can be a sound investment. Step by careful step, Graham helps investors to see the logic of his approach. The first problem that Graham had to contend with was the lack of a single universal definition for investment. Quoting Justice Louis Brandeis, Graham pointed out that investment is a word of many meanings. The issue, Graham noted, does not turn on whether the item is a stock, and therefore speculative by definition, or a bond, and therefore an investment. A poorly secured bond cannot be considered an investment just because it is a bond. Neither can a stock with a per share price that is less than its net current assets be considered a speculation just because it is a stock. Intention is what counts, Graham said. Buying a security with borrowed money, in hopes of making a quick profit, is speculation, regardless of whether the security is a bond or a stock. Considering the complexities of the issue, Graham proposed his own definition. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. That simple sentence is densely packed with ideas, and they deserve our careful attention. First, what did he mean by thorough analysis? He started with a succinct definition: the careful study of available facts with the attempt to draw conclusions therefrom based on established principles and sound logic. And then he went further, describing analysis as a three-step process: 1. Descriptive, 2. Critical, and 3. Selective. The first phase involves gathering all the facts and presenting them in an intelligent manner. The second involves examining the merits of the standards used to communicate information. Have the facts been represented fairly? The final phase requires the analyst to pass judgment on the attractiveness of the security in question. Next, Graham insists that for a security to be considered an investment, two conditions must be present: some degree of safety of principal and a satisfactory rate of return. As to the first, he cautioned that safety is not absolute. A highly unusual or improbable occurrence can put even a safe bond into default. Rather, he said, the investment should be considered safe from loss under reasonable conditions. Satisfactory return, the second necessity, also earned a caution, because satisfactory, as Graham correctly noted, is a subjective term. He did say that the return can be any amount, however low, as long as the investor acts with a degree of intelligence and adheres to the full definition of investment. Someone who conducts a thorough financial analysis based on sound logic and makes a choice for a reasonable rate of return without compromising safety of principal would be, by Graham's definition, an investor, not a speculator. Throughout his career, Graham continued to be disturbed by the issues of investment and speculation. Toward the end of his life, he watched with dismay as institutional investors embraced actions that were clearly speculative. Shortly after the 1973 to 1974 bear market, Graham was invited to attend a conference of money managers hosted by Donaldson, Lufkin, and Ginrett, and was deeply shocked by what he heard. "I could not comprehend," he said, "how the management of money by institutions had degenerated from sound investment to this rat race of trying to get the highest possible return in the shortest period." 5. Graham's second contribution, after establishing a clear and lasting distinction between investment and speculation, was a methodology for buying common stocks that would qualify them as an investment rather than speculation. His methodology turned on a concept he called margin of safety, and here too his thinking was driven by the 1929 crash. The danger of 1929 was not that speculation tried to masquerade as investing, but rather that investing fashioned itself into speculation. Graham noted that optimism based on history was rampant, and dangerous. Encouraged by the past, investors projected forward an era of continued growth and prosperity, and began to lose their sense of proportion about price. Graham said people were paying prices for stocks without any sense of mathematical expectation. Stocks were worth any price that the optimistic market quoted. At the height of this insanity, the line between investment and speculation blurred. As an antidote to such risky behavior, Graham proposed a way of selecting stocks that relied on what he called the margin of safety. In this approach, investors who are optimistic about a company's future growth have two techniques for adding the stock to their portfolios. 1. Purchase shares when the overall market is trading at low prices. Generally, this occurs during a bear market or a similar type of correction. Or, 2. Purchase the stock when it trades below its intrinsic value even though the overall market is not substantially cheap. In either technique, said Graham, a margin of safety is present in the purchase price. The first technique, buying only at market lows, has some built-in difficulties. It entices the investor to develop some formula that indicates when the market is expensive and when it is cheap. The investor then becomes a hostage to predicting market turns, a process that is far from certain. Also, when the market is fairly valued, investors are unable to profitably purchase common stocks. However, waiting for a market correction before purchasing stocks may become tiring and, in the end, self-defeating. Graham suggested that an investor's energies would be better applied to the second technique, identifying undervalued securities regardless of the overall market price level. For this strategy to work systematically, Graham said, investors need a way to identify stocks that are selling below their calculated value. It was his goal to outline such a strategy, and to do so he developed a quantitative approach that was unknown before security analysis. Graham reduced the concept of sound investing to the concept he called the margin of safety. With it, he sought to unite all securities, stocks and bonds, in a singular approach to investing. Establishing a margin of safety concept for bonds was not too difficult. If, for example, an analyst reviewed the operating history of a company and discovered that, on average, for the past 5 years, a company was able to earn 5 times its fixed charges annually, then the company's bonds possessed a margin of safety. Graham did not expect investors to accurately determine the company's future income. Instead, he figured that if the margin between earnings and fixed charges was large enough, investors would be protected from an unexpected decline in the company's income. The real test was Graham's ability to adapt the concept for common stocks. He reasoned that a margin of safety existed for a common stock if its price was below its intrinsic value. And the obvious next question is, how does one determine intrinsic value? Again, Graham starts his answer with a succinct definition: intrinsic value is that value which is determined by the facts. These facts include a company's assets, its earnings and dividends, and any future definite prospects. Of those, Graham believed the single most important factor is future earnings power. That led him to a simple formula: a company's intrinsic value can be determined by estimating the future earnings of the company and multiplying those earnings by an appropriate capitalization factor. This capitalization factor, or multiplier, is influenced by the company's stability of earnings, assets, dividend policy, and financial health. He added a strong caution: the success of this approach is limited by our ability to calculate a company's economic future, a calculation that is unavoidably imprecise. Future factors such as sales volume, pricing, and expenses are difficult to forecast, which makes applying a multiplier that more complex. In spite of that, Graham believed that the margin of safety could work successfully in 3 areas: 1. In stable securities such as bonds and preferred stocks; 2. In comparative analysis; and 3. In selecting stocks, provided the spread between price and intrinsic value is large enough. Graham asked us to accept that intrinsic value is an elusive concept. It is distinct from the market's quotation price. Originally, intrinsic value was thought to be the same as a company's book value, or the sum of its real assets minus its obligations. This notion led to the early belief that intrinsic value was defined. However, analysts came to know that the value of a company was not only its net real assets but also the value of earnings that these assets produce. Graham proposed that it was not essential to determine a company's exact intrinsic value. Even an approximate value, compared against the selling price, would be sufficient to gauge the margin of safety. Financial analysis is not an exact science, Graham reminded us. To be sure, certain quantitative factors lend themselves to thorough analysis: balance sheets, income statements, assets and liabilities, earnings, and dividends. We must not, however, overlook certain qualitative factors that are not easily analyzed but are nonetheless essential ingredients in determining a company's intrinsic value. Two of these are management capability and the nature of the business. The issue for Graham was how much attention should be paid to them. He had misgivings about the emphasis placed on qualitative factors. Opinions about management and the nature of a business are not easily measured, and that which is difficult to measure can be badly measured. Optimism over qualitative factors often found its way to a higher multiplier. Graham's experience led him to believe that, to the extent investors moved away from hard assets and toward intangibles, they invited a potentially risky way of thinking. If, on the other hand, a greater amount of a company's intrinsic value is the sum of measurable, quantitative factors, Graham figured that the investor's downside was more limited. Fixed assets are measurable. Dividends are measurable. Current and historical earnings are measurable. Each of these factors can be demonstrated by figures and becomes a source of logic referenced by actual experience. Make sure of your ground, said Graham. Start with net asset values as the fundamental departure point. If you bought assets, your downside was limited to the liquidation value of those assets. Nobody, he reasoned, can bail you out of optimistic growth projections if those projections are unfilled. If a company was perceived to be an attractive business and its superb management was predicting high future earnings, it would no doubt attract a growing number of stock buyers. So they, investors, will buy it, said Graham, and in doing so they will bid up the price and hence the price-to-earnings ratio. As more and more investors become enamored with the promised return, the price lifts free from underlying value and flows freely upward, creating a bubble that expands beautifully until it must finally burst. 6. Graham said that having a good memory was his one burden. The memory of being financially ruined twice in a lifetime led him to embrace an investment approach that stressed downside protection versus upside potential. There are two rules to investing, said Graham. The first rule is, don't lose. The second rule is, don't forget the first rule. Graham solidified this don't lose philosophy into two specific, tangible guidelines that cemented his margin of safety. 1. Buy a company for less than 2/3 of its net asset value, and 2. Focus on stocks with low price-to-earnings ratios. The first approach, buying a stock for a price that is less than 2/3 of its net assets, fit neatly into Graham's sense of the present and satisfied his desire for some mathematical expectation. Graham gave no weight to a company's plant, property, and equipment. Furthermore, he deducted all of the company's short and long-term liabilities. What remained were the current assets. If the stock price was below this per share value, Graham considered this to be a foolproof method of investing. He did clarify that the results were based on the probable outcome of a group of stocks, diversification, not on the basis of individual results. There's just one problem with this approach: stocks that fit the criteria can be hard to find, especially during bull markets. Acknowledging that waiting for a market correction might be unreasonable, Graham turned to his second idea, to buy stocks that were down in price and sold at a low price-to-earnings ratio. He hastened to add that the company must have some net asset value, in other words, the company must hold less than its worth. Throughout his career, Graham worked with several variations of this approach. Shortly before his death in 1976, he was revising the 5th edition of Security Analysis with Sidney Caudill. At that time, Graham was analyzing the financial results of stocks that were purchased based on these criteria: a 10-year low price-to-earnings multiple, a stock price that was equal to half its previous market high, and of course, a net asset value. Graham tested stocks back to 1961 and found the results very promising. Over the years, many other investors have searched for similar shortcuts for determining intrinsic value. And while Graham's low price-to-earnings ratio approach is still generally favored, we have learned that making decisions based solely on accounting ratios is not enough to ensure profitable returns. Today, most investors rely on John Burr Williams's classic definition of value, as described in his book The Theory of Investment Value, Harvard University Press, 1938. The value of any investment is the discounted present value of its future cash flow. We will learn more about the dividend discount model in Chapter 3. And now, we should note that both Graham's methods, buying a stock for less than 2/3 of net asset value, and buying stocks with low price to earnings multiples, had a common characteristic. The stocks that he selected based on those methods were deeply out of favor with the market and, for whatever reason, were priced below their value. Graham felt strongly that these stocks, priced unjustifiably low, were attractive purchases. Graham's conviction rested on certain assumptions. First, he believed that the market frequently mispriced stocks, usually because of the human emotions of fear and greed. At the height of optimism, greed moves stocks beyond their intrinsic value, creating an overpriced market. At other times, fear moves prices below intrinsic value, creating an undervalued market. His second assumption was based on the statistical phenomenon known as reversion to the mean, although he did not use that term. More eloquently, he quoted the poet Horace, "Many shall be restored that now have fallen, and many shall fall that now are in honor." However stated, by statistician or poet, Graham believed that an investor could profit from the corrective forces of an inefficient market. Philip Fisher. While Graham was writing Security Analysis, Philip Fisher was beginning his career as an investment counselor. After graduating from Stanford's Graduate School of Business Administration, Fisher began work as an analyst at the Anglo-London and Paris National Bank in San Francisco. In less than 2 years, he was made head of the bank's statistical department. From this perch, he witnessed the 1929 stock market crash. Then, after a brief and unproductive career with a local brokerage house, Fisher decided to start his own counseling firm. On March 31, 1931, Fisher & Company began soliciting clients. Starting an investment counseling firm in the early 1930s might have appeared foolhardy, but Fisher figured he had two advantages. First, any investor who had any money left after the crash was probably very unhappy with his or her existing broker. Second, in the midst of the Depression, business people had plenty of time to sit and talk with Fisher. At Stanford, one of Fisher's business classes required him to accompany his professor on periodic visits to companies in the San Francisco area. The professor would get the business managers to talk about their operations, and often help them solve an immediate problem. Driving back to Stanford, Fisher and his professor would recap what they observed about the companies and managers they had visited. That hour each week, Fisher later said, was the most useful training I ever received. 7 From these experiences, Fisher came to believe that superior profits could be made by 1. Investing in companies with above-average potential and 2. Aligning oneself with the most capable management. To isolate these exceptional companies, Fisher developed a point system that qualified a company according to the characteristics of its business and management. The characteristic of a company that most impressed Fisher was its ability to grow sales and profits over the years, at rates greater than the industry average. To do that, Fisher believed that a company needed to possess products or services with sufficient market potential to make possible a sizable increase in sales for several years. 9 Fisher was not so concerned with consistent annual increases in sales. Rather, he judged a company's success over a period of several years. He was aware that changes in the business cycle would have a material effect on sales and earnings. However, he believed that 2 types of companies would, decade by decade, show promise of above-average growth: 1. Those that were fortunate and able, and 2. Those that were fortunate because they are able. Aluminum Company of America, Alcoa, was an example, he said, of the first type. The company was able because the founders of the company were people of great ability. Alcoa's management foresaw the commercial uses of its product and worked aggressively to capitalize the aluminum market to increase sales. The company was also fortunate, said Fisher, because events outside of management's immediate control were having a positive impact on the company and its market. The swift development of airborne transportation was rapidly increasing the sales of aluminum. Because of the aviation industry, Alcoa was benefiting far more than management had originally envisioned. DuPont was a good example of a company that was fortunate because it was able, according to Fisher. If DuPont had stayed with its original product, blasting powder, the company would have fared as well as most typical mining companies. But because management capitalized on the knowledge it had gained by manufacturing gunpowder, DuPont was able to launch new products, including nylon, cellophane, and lucite, that created their own markets, ultimately producing billions of dollars in sales for DuPont. A company's research and development efforts, noted Fisher, contribute mightily to the sustainability of its above-average growth.